for more on how investors can position their portfolios as we look ahead is Ben Gutteridge, who is the Invesco portfolio manager. Ben, great to have you here with us. All right, so as we're thinking about the rally that we've seen post-election here and whether or not this could set us up for a Santa Claus rally even, what are your anticipations as we look to close out the year and some of the themes that you think may carry over into 2025?
Well, look, I mean, it's only natural for markets to sort of check themselves, take a pause for breath. It's been a red hot run for much of the US equity market. But we think a lot of that is built on sound fundamentals. I mean, regardless of the sort of political outcomes that we've just seen, we've always sort of felt the US economy was extremely dynamic. But we also felt that you were getting a nice combination of resilient growth, fading inflation, and increasingly more accommodative monetary policy. Now, I know it can be keenly debated about, how much easier policy is going to get, but we still think we're in a cutting cycle. But anyway, that sort of trifecta, to use it in this circumstance, is quite a powerful mix for equities that could support us into year end and beyond, we believe.
What are some of your favorite sectors then with that regard?
Well, look, I think I don't want to be sort of too on the fence here, but we're thinking about portfolio construction. We're thinking about a barbell. I think it's hard to dismiss the appeal of that sort of loosely defined technology sector. That's such an innovative sector, such incredible earnings power. And indeed, the disappointment for one company, maybe spending a little bit too much on CapEx, is of course good news for the next, given it is sort of the picks and shovels of AI. So look, we still like that technology sector, and in a higher for longer interest rate environment, clearly they don't have any immediate financing challenges either. So not a headwind for them. But the barbell, the portfolio construction I'm talking about, is alongside technology, looking at names like within the financials sector, a steeper yield curve environment, good news for loans. They can charge more for the loans. The growth impulse that we're sort of seeing and enjoying, that's better for the quality of that loan book. And maybe, although it's a tricky one to navigate politically, there is a deregulation story there as well. So valuations clearly not so challenging in that part of the market. So sort of a technology, financials barbell looks like quite a sensible construct to us.
When you think about your own construct and as you're managing portfolios right now, what percentage of that portfolio construct do you think is weighted towards the U.S. versus other parts of the world?
Well, it's the dominant part. Of course, it depends on your domicile. We're sort of looking at international investors within our world, and so it depends where you're coming from, where your portfolios are domiciled as well. But it's got to be the most substantial part of an equity allocation. We know for US investors it's such a huge part of the benchmark, but it's not the case everywhere. But for the international audience, it is certainly needs to be the dominant part of an equity exposure. Perhaps not getting quite as far as 65% as you see on sort of an MSCI World metric, but certainly pushing half the allocation.
And the reason I ask that is because we've seen as well over the past few months a trade that is really more minded around what the stimulus efforts put into the Chinese economy may look like, or additionally something that you pointed out within your notes, US or UK equities rather, and UK long bonds and what that type of hedge is relative to the US as well. So, as you're thinking about those other kind of international mindsets that may prevail for some investors out there, how much of that has perhaps a long tenure in your portfolio, similar to what you're talking about as US tech?
Well, I mean, yeah, it is sort of all eyes on the US, isn't it, at the moment? So we mustn't forget there is plenty of opportunity elsewhere, notwithstanding, as I said, that we think the US equity should remain the dominant part of portfolios. Certainly UK equities, an unloved part of the market, valuations looking very interesting, lots of dividend, lots of buyback, and some very low expectations about what growth can do here. So that's not such a hurdle to overcome. So that looks interesting. Of course, on the Chinese emerging markets, that China stimulus story, we do think a line in the sand has been drawn here. There's clearly an amount of pain that has been reached that the Chinese policymakers don't want that to go any further. But we're yet to see the detail, I think, to sort of really satisfy markets that the return profile looks sufficiently compelling. But I think there's asymmetry. We do think there's asymmetry in emerging market equities at the moment. As I said, that line in the sand looks to have been crossed, could be volatile, but on a medium-term view, expecting some more colour on policy and expecting it to do more to help the demand side of the economy. Therefore, there is opportunity within emerging markets as well.
Ben Gutteridge, who is the Invesco portfolio managing, joining us here on Wealth Today. Thanks so much for the time, Ben. Appreciate it.
My pleasure.